Today we are going to talk about the next steps in enrolling home buyers. So this is for our 3 down payment assistance programs, the Equity Builder program, the Housing Our Workforce, and Lift Up Homeownership. And we do have a lot of ground we're going to cover today regarding this. So we do have the training slides in the handouts, and then I also am putting in the chat some hyperlinks just because there's a certain amount of attachments that can be included. So that way you have all the resources that we're talking about today, and if for some reason you need more information, we'll go into that, and you can always reach out and email anyone on our team. Right, with that, I'm going to stop sharing my webinar cam. Give a little more real estate. All right, so we have 3 programs that your organization may have applied for. So the Equity Builder program is our oldest program. It's regulated by the Federal Housing Finance Agency. It's for down payment and closing cost assistance for households at or below 80% of the HUD area median income. And we're going to get into what that entails today when we're talking about area median income, or for acronym purposes, AMI. And the Housing Our Workforce, that's a voluntary program that we added that also provides down payment and closing costs, and that is for that missing middle that's slightly above 80% and up to 120% of the AMI. And lastly, our 3rd program, which is also a voluntary program, Lift Up Homeownership, that provides down payment and closing cost assistance to people of color earning incomes at or below 120% AMI. And altogether, we like to market it as a suite because we are offering multiple income brackets, but then also the LUH program falls under a special purpose credit program where we are able to provide assistance specifically to people of color based on the analysis and written demand that is in line with SPCPs, saying that if there's a disadvantaged class of persons that you are able to offer it, providing that you have the data. So if you're offering Lift Up, we provided our written plan to you at time of annual agreement. So this is just an example of showing what you can do with this grant. As I mentioned, it is for down payment and closing cost assistance. You can layer these programs, which is wonderful. This is an example of LUH recipient that was able to use a portion of our money from the LUH grant toward down payment. They were able to layer it with Amass Dreams. And what we found is by utilizing it on a case-by-case basis for that individual borrower, you can tap really into their savings. And one of the things is that this household in particular, because they were able to leverage this toward down payment, they were able to save themselves around $307 a month. So this just really kind of shows where the money goes and the value of it. And that's why we really want to promote looking at what the use can be for the program overall, but then also to focus on here are some good examples. So this is the grant step-by-step process, especially if you're new to the programs. So you've already applied to offer the program. The award notices are going out next week, and then enrollments are beginning in April. So basically, if you have a buyer that has an executed purchase and sales, you're able to compile the required documents that we're going to talk about today. You're going to submit the enrollment, which is basically the application. We just refer to it as an enrollment at the Federal Home Loan Bank. And then it is going to go into our queue for the review process and approval, and that typically takes around 15 business days, and that's really just a benchmark to be able to give us enough time to do the intake, and if for some reason we need more information. And then once we've issued an approval, your institution is going to close on your first mortgage. You're going to table fund the grant, and then you're going to execute all of our instruments, which we cover in our disbursement training in April, and then you're going to come in and request the reimbursement through the same process and portal in our community lending login, and then we review that, and then within 20 business days we'll fund your institution's ideal way account. So that's really just the step-by-step process. And then we just want to note too that we don't work with home buyers directly, so if they do contact us, we give them very generic information to let them know that we're wholesale. We have a list of approved banks and credit unions throughout New England that you are able to access and work with them. So just want to know, don't direct buyers to come to us to determine income eligibility, or if they have any questions about the program. We're really using your institution as the gatekeeper and lender to be able to determine income eligibility and reserve the grants. So this year, we are releasing April through July, and each program, first off, has its own pool of money. We are operating on a 4-month cycle, so we are doing drops twice a month. So the first business day of the month and then mid-month, and that way we're giving as much time to be able to see who you have in your pipeline, depending on your purchase and sales agreement. Full screen mode. Just 1 second. Oh, wonderful. I guess somebody was having some sound issues, so it looks like that was resolved. Sorry about that. But back to the allocation schedule for 2025, it is listed on our website, and then each program has its own pool of money. And for this year, EBP and HOW have a graduated member cap. So we have a maximum allotment that each organization can reserve. It's never guaranteed. It's always on a first come, first serve, but we do have these measures to be able to be as equitable as we can for these programs, because we know we're all of New England. There's a lot of banks and credit unions that offer these programs to their customers. And EBP, what it will do is it'll start with a $125,000 member cap and the same amount for HOW, and that's for the first 2 releases. And then in May, it will increase to the $250,000 max. So say, for example, if you were about to hit your 125 cap, or you have hit it, once you're in May, you are able to get up to the 250. So, just something to note, because it's different than what we've done in prior years. But if you're used to the Jobs for New England program that we have for small business lending, it's a similar premise, and we found that has been successful. Up Homeownership does not have a graduated member cap. The maximum is 500,000, and that's because it is a different grant amount. And any money in general is always placed back into the general pool, and things are subject to change, but we are kicking off the first release on April 1st. And before I go to the next slide, it looks like some participants cannot get into the webinar because it's full. So it might be an attendee maximum issue that we're currently experiencing, but we are recording the training. Like I said, we did have a lot of registrants, and it appears that most of them did attend today. So I do apologize for the inconvenience, but we will get this recorded training up on our website as soon as we can, and that way you can direct people who maybe are unable to get into today's webinar, the recording. And also we do have some availability in the next training that is coming up on, I believe it's March 25th. All right, so in addition to how we're releasing the money for 2025, another thing we're implementing in all three programs is each program has its own pool of money, but we have a state-by-state allocation than in an at-large general pool. We did this for the Lift Up Homeownership program last year, and we did find some success. And first off is to make sure we're serving our entire footprint of New England, and then also just making sure we can be as equitable as we can for these programs, because we know that everybody has scarce resources. Buyers really need as much down payment and closing cost assistance monies that are out there in order to get into the home ownership market. So what we do is when we first release a batch of money, the property address is going to be tied to a 250,000 per each New England state. And then once that state, for example, Massachusetts does have a lot more member banks and credit unions. So once you've met that 250, it just rolls over to the general pool. It's nothing that you specifically have to mandate and be able to review. Our system automatically does that for everyone directly, and you'll be able to see when you log into the portal as well as the daily subsidy emails. It'll tell you how much money's left in the pool, and it will also tell you the breakdown of availability in each New England state. And once that New England state has been met, that it doesn't matter where the property is. It can just go into the first come first serve standard. And then we're only reserving the money in the New England state pools for 60 days. So any money that's not used in, for example, let's just say you're a member in Massachusetts, and that pool has already, rolled over to the general. Maybe the Vermont pool has not been fully utilized. That money is going to go back into the general. So any property address can be registered. It doesn't have to specifically be in Vermont. But if you have any questions, reach out to us. Like I said, we're doing all of the review and allocation, and then you're really just going to see that in live time when we are implementing these measurements, just to be as equitable as we can, where the funds do go quickly, they are competitive. So I mentioned that it's for down payment and closing cost assistance, but just to get a little more granular, so closing costs do include prepaids and escrows, and it can be up to 2 points for interest rate buy down, just to make sure it's as affordable as it can be. If you are using our mortgage partnership finance permanent rate buy down product that we rolled out last year and we're also continuing this year, that is up to 2% interest rate reduction. You can't use the grant money to then reduce it another 2 points or 2%, depending on what the math is. You would have to be able to maybe allocate that toward closing costs or down payment, but we might see a lot of that overlap, and there are some differences in those programs. But I just want you to be mindful, if you are a PFI, a partnering financial institution with the MPF product, it's our secondary mortgage product, that you just are considering these other overlays. And it does have to be a purchase within New England. It is 1 to 4 family homes, townhouses, condominiums. We don't care if they're warrantable or non-warrantable, cooperative housing units, and that can even include, any shared equity products that are on the market, manufactured housing, we do see a lot of mobile homes, as long as they're permanently affixed or wheels up, axles down, and the homeowner takes title, that is an acceptable property. And if they're leasing the land, that's fine. We get a lot of those questions as well. They just have to take the title, and then also you just want to factor in that ground lease into your housing ratio. All right, so comparing the programs. So the AMI limits are the first thing that differ, and we talked about that on the suite of programs slide, so I don't want to go into too much detail. Lift Up Homeownership does have a self-certification where, in addition to the up to 120% area median income, it is a self-certification because it is for people of color only. And then the grant amounts are different. To start with the higher amount, the LUH program is up to 50,000. And then for EBP and HOW, they are both at 25,000. For EBP, we did have a little over 30,000, but we did do some analysis in seeing that there were a lot of other programs that are available and being layered with our low to moderate. So we did reduce it slightly by 5,000 because we really want to be able to serve more home buyers. And then the HOW program, we did eliminate the 10% of sales price or 25,000, the lesser of the two, just to keep it as streamlined as possible. I talked about the member limit cap already, so I won't go into too much detail. The minimum homebuyer contribution, it does have to be their own funds. EBP is 500. HOW is 2,000, which in prior years it was a certain percentage of the sales price. So we also streamlined that. And then the LUH is 1,000. So just to keep it at a specific monetary value, just to remove any complexities and just make it a lot simpler. But if you're going through the vetting process and identifying home buyers, you just really want to be mindful of these differences. EBP and LUH does have to be for a first-time home buyer. HOW does not. However, they either have to previously sold their primary residence, so they have to sell at least by the same day close, and they can't convert it into an investment. And then if they're first-time homebuyers, they do have to take education and counseling, and our programs are specific to owner-occupied primaries. EBP, to go back to the customary closing costs and use of funds, one thing I do want to point out, which I see as a question, is it can't be used toward the real estate commissions. I know that there were some changes on who was responsible, whether it was the buyer or seller. It has to be on the second page of the closing disclosure, but a cost that is not affiliated with the real estate commission, depending on how you're reflecting it. It can include prepaids and escrows. It can fund upfront mortgage insurance, or if there's any PMI that's attached to it that is upfront single premium. And then EBP can be used for rehab only. I recommend if you are going to do rehab to really look at our procedures, which I hyperlinked in here. And I do see a lot of questions, so I'm going to go through some of these right now. Will your portal let us know at time of registration if there are no funds remaining for the specific state? So yes, so all that's live time when you're logging in. You're getting the emails around 9 o'clock in the morning. So if we release funding and you want more of that live time, I recommend using the community lending portal, because you're only getting an email on 9 a.m. when there's money available and if there continues to be. So the best indicator to see what has been utilized, what's available, what your organization has reserved is directly in that community lending platform. I do see a couple of things that are regarding income guidelines. I'll get to that a little bit later. And going to the closing costs, one of the questions, but I did answer, I just want to clarify though, does closing costs include page 3 prorations? No, it does not. So it really has to be associated with the purchase of the property. So if it's any water bills or oil prorations, no, the buyer has to be responsible for that. Our funds can't be used toward that. And then can we use grant funds to buy down the rate on a portfolio product? So if you have your own portfolio loan and you want to use this down payment funds toward up to 2 points, yes, that is possible. It doesn't have to necessarily be on the secondary market. And then I just only mentioned the MPF program because we have a permanent rate buy down program. So you can't double dip with that secondary market product in conjunction with our grant product. And how, if they sell their primary, they cannot retain any other REO, correct? Yes, so they can't convert that into an investment property. The hyperlink to the rehab, so if you go into the EBP how procedures, and if you just do control find or control F and type in rehab, you'll be able to put that information in there and it'll pull you to that direct section. But all very, very good questions. So homebuyer requirements, they do have to execute our disclosure. So EBP and HOW are the same disclosure just because you might not know which income limit that they have. Make sure you purge yourself of all 2024 documents. We can't take any stale disclosures because we do update them annually. And then the LUH has a similar disclosure, but it does have information about the SPCP program. So you just want to make sure if you have an LUH customer that meets the criteria of that program that you execute that disclosure. They do have to meet the area median income limits, and we're going to get into this today, but we're not qualifying income. We're prospective, so we do differ from Fannie and Freddie. We're compliance over 12 months, and we include anything that's anticipated in the future. So I like to say we're a blend between HUD, Fannie, and Freddie because we're all persons in the property and all income sources. So if you have a household of 4, let's say, and you only have one borrower, and there's 2 adult household members, there are 2 minors, that's a household of 4. And if both adults receive income, you need to get all the income documentation and factor that into the grant submission. And then you do need a fully executed PNS. Please do not provide us with closing dates that are before our 15 business day turnaround time. I'm going to focus that at the end of the webinar, but I can't say it enough. We can't take those stale documents. If you have somebody who has a PNS that's executed before the first release, just make sure you're looking at that closing date and it's not on April 1st, or if it's expired, get those extensions up front. Just because these needs, the need for these funds is definitely crucial for people, and we want files that are fully baked. And the home buyer does have that minimum contribution, and that could be in a form of an earnest money deposit or any cash to close, or also if they've paid for certain upfront fees, but that money has to stay in the transaction. So if they put down more than what our minimum is, depending on what your underwriting requirements and your mortgage product, they can't get that back, because we also, more importantly, they can't get more than $250 cash back at closing. That's a regulatory hard stop for us. So just be mindful of those things when you're looking at submitting, and then also when they're approved for the grant. And then when we're talking about the AMI, it is for the town that they're purchasing, not their primary residence. All right, so when you're interviewing the buyers, we are going to be operating under the 2024 HUD income limits until HUD releases them. Traditionally, they do publish between April and May. There might be a delay this year due to the time frame and limited staffing over there, but we will determine and announce when we're going to change over, and we'll provide ample notice. We do include a message on the EBP How LUH pages when you log in with your community lending. But for right now, you can reference, and I do have a slide coming up that goes into the AMI and how you're looking at it for the 3 programs. When you're identifying the household, you want to make sure it's looking at an individual who's expected to live in the property at time of closing and moving forward. That could also include some scenarios where there's 50-50 custody that is included in the household. Maybe if somebody's a full-time student, but they come back for the summer and other times, like that person does live in the property, unless they have another apartment that they're living in outside of their familial household or adult caretaker. Income wise, it's incomes for 18 years or older that we include their income. If they are a full-time student, they do need to provide proof. So if it's a tax transcript, a transcript that shows that they are enrolled in a college, also it can't be the adult borrower that's on the purchase and sales. We don't consider them a full-time student. We would have to factor in their employment. See, lots of questions. So I did answer that already. For Lift Up, do you have more than 5 household members form to use? So if you have a very large household, it goes up to 5. Just photocopy one of the households indicator pages. We do see that often. You can do that with all of our programs. All right. Getting a lot of questions about non-citizen borrowers, as well as confirming legal status. So we're really looking to your first mortgage underwriting. We tell you to follow Fannie and Freddie. So I would really just focus to that. And if you have any questions, you can talk to me offline. But that's how we operate our programs, because we don't look at the full 1003. And someone asked when we get approved for the application. It's going out next week. And then we do have another question that's related to other considerations, non-occupant co-borrowers. Just want to see where that is. So non-occupant co-borrowers, they considered households income. Our income guidelines are very detailed. We do not include the non-occupant co-borrower income. However, if your non-occupant co-borrowers on there, not just for credit, maybe it might be for the housing ratio, maybe that the AUS findings do require a lower front DTI, if you will, and that non-occupant co-borrower gets you in that. If your housing ratio is over 37%, just in general, we require compensating factors. And if one of your compensating factors is that the non-occupant co-borrower is going to be financially contributing to the mortgage, that we would consider income. And we do have that spelled out in our income guidelines as a reference. We already talked about that. They can't convert a primary residence into an investment for how. One question is, if someone is getting divorced and buying out a spouse, could they qualify for how income limits? Could we qualify them for how? I think I'd have to have a little more information. Are they buying out the the marital home that they're living in, or are they buying another property? Because if they're buying the property that they currently live in, that would not meet the spirit of our program, I believe, just because they currently own the property. Okay, so for the LUH homebuyer self-certification, it needs to be executed by one of your borrowers at minimum. Of course, if you do have multiple persons of color, we welcome you to execute the self-certification, but in order for them to be eligible for this program, they have to execute our document. We do not look at 1003s. This is basically our 1003 certifying that they are a person of color, and they can select as many that are applicable. They don't have to select multiple, although we encourage that as well, just so we can see, where our funds are going and just try to show as much success in the program in general. If they don't wish to furnish, the loan officer can't just fill it out for them. It has to be certified from the buyer. So if they don't wish to furnish the information like HMDA, they wouldn't be able to qualify for the Lift Up program. We do get a lot of questions about mixed race households. Like I said, it just has to have one borrower that identifies as the options that are listed on the screenshot of the disclosure, which is also attached under the handouts. And we do have FAQs out there, especially for the LUH program, but all of our programs that dive into the people base and the SPCP. So that's definitely helpful material if you're new to a special purpose credit program. So income calculation best practices. First off, always manually calculate alongside entering the system, because we're compliance income, we're not qualifying. You're going to treat this as an additional underwriting layer that varies from yours. There are some times that maybe our platform can't account for varying factors such as seasonal employment, if they have any paid or unpaid medical leave or other unique scenarios, reach out to us. But for the most part, our income guidelines really do try to cover all of these, because we know that not necessarily that, it's a cookie cutter W-2 wage earner that doesn't have overtime, just gets a gross, weekly pay, for example. We really try to encompass all scenarios like self-employment, rental income. If the person is buying a rental property, we do include 75% of the gross rental income. You'll need documentation for that. Our income guidelines are very detailed on, we either need that current lease, or you're going to need the appraisal showing the market rent. There are some unique scenarios that we would potentially exclude it. I want to say that very carefully, because if you're using it to qualify in your first mortgage, or if you're using another, housing finance agency product that makes you, if you're counting it, we're counting it, but definitely really read the fine print in that section. So we have a whole section of rental income, and we also have a full section of self-employment income. We use 2 years tax returns. We do include depreciation. If it is an S corp, that's fine. If it is if there are K1s that are tied to it, we do need the K1 if it is a partnership, and then we are going to need those business returns too, because we're all in for self-employment, and we do have very explicit details on that too. And then really just review those income guidelines, and you can also look on the HUD website and get an idea when you're manually calculating before you reserve. And here's an example of all three programs. So if you were looking in Boston, Mass, and one of the questions related to this was, is it by town of where they're purchasing? Yes. And traditionally, the way that HUD works is it does encompass cities and towns and certain metro FMR areas, if applicable, or it goes by county. Just really look at it, because in New England, we're very unique in the sense that there are split counties. So sometimes that's zip code based, sometimes, if there's a village in the state of Connecticut, it's pretty common. There are multiple zip codes that are in a city or town. Um, just really look at that. And when you go into HUD, it's going to ask you to select the state and then that town, and that's where it's going to give you um, the limits that they're listed. So for this example that we pulled up, we selected Boston. We don't use the median family income. It is the persons in the family. So I've given the example of a household of four. So if it was for EBP, it would be under 2024, $130,250. If they need to go into the HOW program, they have to be $1 over. And then to get to our 120 limit, because we are all of New England, we're taking the 50 and then we're multiplying that by 2 and then multiplying it again for 1.2 to get that 120. So for how, they would have to be over $1, and then the 120 would be for a household of four, $195,840. And then lift up just goes up to the 120. So you wouldn't need to be over the 80 for that. So if you have any questions, feel free to reach out about that. I do have a question on homebuyer education and counseling. Does the education counseling need to be completed before prior? The answer is no. It just has to be within 24 months, either at time of enrollment submission or closing, just depending on if it's a new construction property, when did they take the course, and it's in favor of the customer. All right. One person asked, when do you get approval for the application? I don't know if you're referring specifically to your member institution to be able to market and offer the programs, or if you are specifically talking about uh, the grant reservation. But the enrollment grant reservations, they are typically approved within the 15 business days from when they submit. Prior that, it's a clean file. We haven't gone back and forth. Do you allow Fannie Home View for first-time homebuyer classes? Yes, we do. We do want you to be mindful that they do have to complete some sort of counseling component, whether it's prior to or post-closing. And does Home View include the one-on-one sessions? That's a good question. So I believe they can opt out, just like Framework. That's why we tell you it's your responsibility to ensure if they're not just going to an approved agency, like in Massachusetts, MAHA is an example, and they allow the hybrid blended approach where the education's online, but then they require the one-on-one counseling in whatever format. You just want to really just do your due diligence on that, but we did add that this year. So if I'm clear, the lender is responsible for calculating the compliance income. Yes, and definitely do it manually, have everything before you're reserving it to see which program. So that's the other thing too. You really want to have your ducks in a row because you can't swap programs. In the past, we were allowing EBP and HOW that it would bring you to that specific program. And if for some reason they didn't belong in it, you could switch just due to the demand of the funds and a lot of moving parts and changing and making sure that we're doing an appropriate and adequate compliance review. You really have to do that due diligence up front. The funds do go quickly, they are competitive. Really just make sure you have seasoned people in your residential lending that really know the programs inside and out. And we have so much training, we have so many resources, and you can also refer to this recording if you ever have questions as well. All right, so if we don't have all the information required, you'll have to, we at the Federal Home Loan Bank will put it in member action required. You have within 10 business days to provide the documentation or clarify. And if we don't have any information, we do have the discretion to be able to deny it just because there are other people in the pipeline that might be eligible, they might be ready. And if you need more time, just refer to our extension policy. We have a whole section in our EBP how procedures as well as our LUH. And like I said, you can't move a home buyer from one program to another regardless, and especially if they're placed in member action required. So we'll have to ask you to, withdraw the enrollment and then submit under the appropriate program, also pending if there is funding available. So some common examples, and the first one is certainly our largest example, and we are really having a firm stop on. If the closing day is less than 15 business days, you need to get an extension upfront, or we can deny the grant. It really is, we can't expedite any reviews just because we have a lot of money this year in all three programs. We have other programs at the Federal Home Loan Bank that's under the Housing Community Investment umbrella. So we want to also set those expectations as transparent as possible, and we really just want you to also set that expectation with your customer. We get that things happen, but just due to the need and the increase in funding, you need to get that stuff up front. The other thing that we typically put things in MAR, member action required, is that the disclosure is typed and it's not properly e-signed. If you have our PDF document and you want to use the e-sign function, because we don't work directly with vendors such as Encompass, DocMagic, Adobe Sign, it's your responsibility to make sure that you configure that properly. You can't just type in someone's name and their initials. It does have to be either wet sign or a formal e-sign functionality. And then don't give us expired income documentation. We do kick that back a lot. If you are giving us pay stubs is pretty common, or verification of employment. If it's not within 45 days of the enrollment submission, we are placing files in MAR because we're prospective. We need the most current information. Sometimes we do kick it back if a housing ratio exceeds 37%. You can find that also in our EBP how procedures as well as our LUH procedures. We require compensating factors. Our online platform does allow you to enter the compensating factors, but just to go over if you are new, what is their current rent? Is there minimal payment shock? Do they have minimal or no back end debt? Those are compensating factors. Do they have maybe 2 to 6 months reserve after the purchase? If it's anything that's out of those three things that I mentioned, like good credit score, or they've had a long-term employment for 15 plus years, those aren't really tangible compensating factors to demonstrate their ability to repay and sustain home ownership. We would need you to certify that you've really looked at their ability to repay, and if it is higher than this, that you've reviewed that underwriting accordingly. And then these are the outcomes for that. So definitely a great thing to kind of earmark as you're going through what are some examples. And I would say we're probably at a 70% rate of putting files back in member action required. We did do some cleanup maybe 3 years ago, but I think also just due to the high demand that people are kind of just throwing in things that have placeholder documents, or bad information, and unfortunately that really has increased our turnaround time, but also like the success rate of what we would consider a clean file. So please don't send placeholder documents. Only submit and reserve the home buyer under one program. You can't submit them under multiple programs. We do have something that flags us and lets us know that information. So if you realize that they're not in the correct program and you haven't fully submitted, you can withdraw. If it's already under our review, you have to request it from us to do the formal withdrawal or denial. And then also two other things, the subject property can change, the home buyer cannot. You can't swap out buyers. And then also we can't make exceptions this year. I can't say it enough, that if the closing date is less than 15 business days from the day you reserve, just because we have a lot of people that need the money. Always refer to the procedures and the income guidelines that I put in the chat in the hyperlinks. I'm going to answer some of these questions as well. If a person identifies as I do not wish to provide, can we move forward? So that's probably for the Lift Up program. If they don't want to identify or furnish, then they're not eligible for the program. We can't require them to self-attest, but if they don't, there's explicit legal jargon on there that lets them know that they don't qualify for the program. If they're income eligible but they don't want to select one of the criteria, then they would need to go to another program, maybe EVP or HOW. All right, so approved homebuyer education online options, are they the same as 2024? So we did add a couple. So it's eHome America, it's Fannie Mae Home View, Finally Home, Framework, and then Home Track. So we did update our EBP, HOW procedures, as well as our LUH. For the HUD income limits, do we have to calculate, or when we enter the system, will it help us determine this? So I always recommend that you, if you're new to the program, especially looking at the HUD income website for the limits and then doing a manual calculation. But the community lending login, it will ask you for the total persons in the households, what types of income that are attached to that respective individual, and then you're going to have to enter in the information on the documents. It'll act as a calculator and build a table, and then it'll show you what the annualized projection is. In conjunction with the limit to make sure they qualify in the appropriate program. But we say to manually calculate it too, because there could be some unique scenarios that I previously mentioned that maybe it can't grab that. So we just recommend that you do that. And we also do have a YouTube channel that gives you a walkthrough of the community lending platform. It gives you step by step on how do you create a login, how do you annually apply, how do you reserve an enrollment, and it gives multiple income sources. We used to have a manual that had screenshots. We update the website often. These are just quick hit videos, and we really just want to focus on these webinars on the process, the changes that we've made, and allow you to have opportunity to ask questions. Can you repeat about post-closing? So the post-closing was referring to if you have a buyer who did the education and they still have to complete the counseling component, they can do it prior to or post-closing. Do you need appraisal title for the 15-day review? Great question, actually. So we do not. However, there are certain situations where we do require the appraisal. We never require the title. Appraisal would be if it's a manufactured home, we need to evidence either it's permanently affixed or wheels up, axles down, or if there's some sort of certification or documentation that the realtor can evidence. Appraisal for a multi-family, especially if you're including rental income and you don't have current leases, you're going to need that for the market rent. But then also, if you're excluding it for your first mortgage qualifying and you want to exclude it to qualify here, we need evidence that the property is vacant. So those are the only scenarios that we would need the appraisal. Something tied to appraisal, but we don't require the report itself, is if it's a related party transaction, our online system will ask you to confirm the appraised value just to make sure our money can never, but with related parties, it sometimes gets a little complicated depending on if they're selling it for a below market. Our money in general can never be to bridge the gap between sales price and appraised value, but we do require that additional checkpoint and just you to type in and verify what that information is. And definitely look at the related party section for what we constitute as a related party, because it could be a rent to own, a landlord, renter circumstance. If a borrower is under 80% who has owned a home before, won't be eligible for the program since EBP has to be a first-time home buyer, and how is only available to above. So yeah, unfortunately, they wouldn't qualify for our programs. For EBP and LUH, it does have to be a first-time home buyer, and then they do have to meet the at or below 80 for EBP and the at or below for 120 LUH. If they're less than 80 and they aren't a first-time home buyer and you're trying to qualify them for how, they wouldn't be eligible. Okay. Please confirm on a 2-unit. Assume this includes in the AMI calculations. Is it based? Oh, yes. So I did answer that. It's 75% of the rent, whether you're using a current lease or you're using the market rate listed on the appraisal. DTI compensating factors for all three. All three of them aren't required if they're over 37%, but depending on how high you're going, if you're going to like a 52, like an FHA loan, we would want the 3. It's really at our sole discretion. And just because these interest rates and people's mortgage payments are more than 30% at times, depending on where they're buying and what they're buying. We just want to really set them up for success. So really just making sure the affordability is there, and not even just the affordability, but to be able to sustain that home ownership. Borrower's income is qualified for the program but has a large gift for down payment. They still qualified. So that's a great question. So we do not perform asset tests presently. They just have to meet the minimum home buyer contribution of their own funds. That can't be a gift or a gift of equity, but if they're getting any gift funds or a gift of equity for any of our programs, that is acceptable. You just need to make sure they meet that minimum homebuyer contribution because they have to have some skin in the game. What is placeholder documents? So we've seen people that they'll just put stale documents, or they'll put notes saying, we have this documentation requested, but we haven't received it yet, just to be able to reserve the money. Or for example, if it's a purchase and sales agreement, they'll put the offer, which we can't accept either, just because this is pretty competitive to be able to reserve the funding. That's what we call a placeholder document, if you will. If you enter borrow information prior to the funds dropping and upload docs when the funds drop. So you are able to put certain information in documents prior to a funding release. You won't be able to do the second step, which is enrolling the household, which includes the first mortgage information and anything that's tied with the property and those documents. The first step is to build the table, build the household and their sources of income to determine their income eligibility. And we keep that tool out there because it's a way for you to help to determine if they're income eligible. So you would never really be able to go in and just hit the button when money was released. You would have to go through logging in, selecting the buyer, and selecting the enroll household, and then entering all that information for formal submission. Will you take an offer in lieu of P&S? No. I did say that too. So, okay. Example, purchase price is $670,000. Borrower is qualified for $270,000. Parents are giving a $400,000 gift. Do they qualify for the program? Essentially, yes, they do. We just tell you to really be mindful is when you're working with customers that really are contingent upon the funds. we don't perform asset tests, but we're really income eligibility at this point. But just kind of look to see who you have in the pipeline and really making sure that you're meeting that spirit of the program of increasing home ownership and affordability, because there are some people that don't have the bank of mom and dad, unfortunately, and maybe that down payment is that one deterrent for them to get a home. All right, some misconceptions about our programs is that a buyer can't refinance. They can. They can actually refinance as many times as they want. We talk about this in disbursement training, that there's a 5-year retention period. So you're going to monitor the grant whether you sell the first mortgage on the secondary market. You cannot sell the grant. You're going to have to keep the grant because you're the lender. The way that the mortgages and notes that we have, and we do cover this a little more detail in disbursement training, but you're the lender, we're only the funder of the grant. So if someone wants to subordinate, we will. It doesn't matter what type of refinance transaction or home equity line of credit. And the other misconception is that the buyer can never sell the property. There are some other grant or 0% or low interest loan programs that do have those restrictions. We just require that they have to provide ample notice, preferably 30 days if they're going to sell the property, because there could be potential that monies will be paid back. And we do cover that in our disbursement training in April, as well as in our procedures. And some people also make the assumption that they have to be buying an affordable unit or having a deed restricted property. They can. That's awesome, especially if like you're in Massachusetts and they have the 40Bs, or if you're going into other New England states, if there are affordability covenants, we welcome that. We think that's wonderful, but that doesn't have to be the only requirement to be eligible for the grant programs. Another huge misconception is that if a buyer has Section 8 voucher program for home ownership, that they can't be eligible for the grant program. That's false. For example, we've been working with some lenders who offer, the Boston Section 8 homeownership program. We don't include that as income. That is really just a compensating factor. Like I said, we're trying to do our due diligence to increase affordability. So tips and tricks. Please don't promise the funds to your home buyer prior to receiving enrollment approval. Can't stress that enough. Please promote the programs. We do have marketing material that is available on our website right now. If you log in to your community lending platform and you select EBP How landing page, there's a press release for that program, those two programs, as well as a home buyer flyer. If you are looking for lift up materials, those you just have to go to the LUH landing page and you'll see those right in that platform once you log in there. Don't guarantee the funds. It can't say it enough because it is first come first serve. We get a lot of calls from home buyers saying that they were promised the funds, or they're having complications where they want us to income qualify them, and we simply cannot because we're wholesale. So just really make sure you're having those honest and open conversations with your buyers up front, and just there is no risk of sharing this information out there, but just letting them know, and that transparency that is on a first come first serve. Don't submit income eligible home buyers to more than one program. Please queue up home buyers before monies are released so you can determine that income eligibility. And please don't provide us more documentation than requested. We are looking at the income and we issue the approval at that point in time. If something changes that potentially doesn't meet the spirit of the program, I mean, those are extenuating circumstances that kind of would fall into like an unintentional fraud. So that's not what we're referring to. It's more just like, oh, they have more overtime since you approved it. We're looking at it at that point in time. An example of unintentional fraud would be a situation, say maybe you knew a buyer had two jobs and they told you they were discontinuing the second job, and little unbeknownst to your shop that, maybe they did that because they wanted to qualify, and then you found out they were going back to the job once they were eligible and they're actually working more and they got a raise at that second job. That's potential fraud in that sense. So just make sure you're having those conversations with your borrowers up front. We're all in for all income. It looks different than first mortgage qualifying income. And watch our YouTube tutorials before submitting and reserving, especially if you're new, because it really will give you those technical skills, if you will, and that assistance, because especially when we drop money the first day, it is a bit of a hectic frenzy, if you will. So we just want to set you up for success. And they're just quick hit videos. It breaks down the income and all income types. They're, between 2 and 4 minutes, depending. And we really just want to be able to give you those step-by-step instructions and more interactive material layered with our procedures and income guidelines. All right, I know we do have questions, so I'm going to pause and see if anyone has others, and I'll catch up. A couple of things I wanted to do is to kind of test the brain, is ask a couple of questions. So, all right, so the poll is, whose income is included for any of our homeownership programs? Give some time for everyone to weigh in. Don't be bashful. This is really just an exercise to see if our trainings are interactive but also effective. Just going to give it a couple of more minutes where only half people voted. Take a stab at it. No one's getting graded. All right, so we have a good amount of people. So the answer is all adult household members 18 years or older. All right. Let's see, we have another question. Can a buyer be swapped out with another home buyer in your pipeline? I did throw in a yes or no because sometimes multiple choice gets a little complicated. All right. All right, so I'm closing that. So the answer is no. Each enrollment is home buyer specific. So if you do have a situation where you have a buyer that falls out and you want to enroll somebody else who's eligible, you have to formally withdraw the prior person and then submit. You just can't simply transfer the funds over. And also another question we get is, say maybe a buyer went to X bank and they want to go to Y, that reservation doesn't transfer directly over. And we do have some language in our procedures and our implementation plan as well, saying that buyers can't shop around and apply to multiple banks for the program, just because we also want to be, as effective with our review process, our turnaround times. Home buyers are savvy and eager, but also, it impacts your institution if there are two different lenders that have the same buyer and they're both trying to reserve money. That's kind of clogging up the pipeline for other prospective and potential buyers. All right, I got another one. Actually, okay, we got one more question. So is your organization's maximum member cap guaranteed to your income eligible home buyers? All right, so I'm gonna close that. So no, it's on first come, first serve. Awesome. Well, thanks everyone. All right, so back to the questions. Is there a maximum housing DTI you won't go over even with compensating factors? That's a little complicated because it's not really a one size fits all. We have done analysis for our programs that 37% is pretty reasonable. However, it depends on what the compensating factors are in conjunction with that DTI. For example, I have seen in the past a higher DTI. I'll just use 50% for this example. Maybe it's an FHA loan because they will go a little bit higher than Fannie Mae or Freddie Mac, but maybe they're already paying rent and this is actually going to be more affordable for them. Maybe they're paying, I'm just making this up, like $4,200 in rent and their PITIA is going to be 3,700. Well, that's a no-brainer in the sense that this is actually going to be helping them. Um, that's unique, but that's kind of why we put these benchmarks out there. And you really just have to demonstrate that ability to repay. We've also seen situations where maybe the way that the self-employment is calculated is different because we do a 2-year average. Maybe for your portfolio purposes, you're only doing one just because maybe averaging gets them a higher debt to income ratio, or if there's foster care, we don't include foster income, and we also don't include uh, foster children into the household makeup. So that's really kind of a question that's difficult to answer, but those are some things that I and my team have experienced. I missed the 3 circumstances for the situation if an appraisal is required. Manufactured home, multifamily, and. So it's just manufactured home or multifamily. The and is if there's a related party transaction, we require you to certify what that appraised value is. We don't require the report necessarily, but if that's what you need to determine that appraised value, then you would need to probably wait for that, or depending on if your automated underwriting system did generate that for you and they didn't need an appraisal, just because I know that certain DU doesn't require that, just depending on, that make of that borrower, depending on their loan to value and other criteria. What is the minimum down payment amount and percentage of purchase price? So it's not it's not tied to a percentage in purchase price. For EBP, it's 500,000. For how it's 2,000, and for LUH, it's 1,000. How used to be tied to 1.5% of the sales price, which was fairly in line many moons ago with Fannie and Freddie, but now that they are only saying that they have to have a minimum down payment, whether it's the home buyer contribution or a gift. We wanted to be able to relax our requirements and be a little more thoughtful to that, but then also focus on that the buyer does have to have some skin in the game at minimum. Fannie Mae Home View does not have an exit interview. Is this acceptable? So if they don't have an exit interview, you have to monitor and ensure that your customer has completed the counseling, whether it's before or at closing. And we do have a list of approved agencies, which is why we have difficulty with certain online platforms like Fannie Mae, because they either don't offer the one-on-one or the buyer can opt out. So we do recommend that you go through an approved agency that offers one of these online programs. Are there purchase price limits? So yes, for how there is purchase price limits. I should have put them in the chat. If I didn't, I apologize. There was a lot of attachment restrictions that I had, but if you go under the how page, under, I believe it's eligibility, you'll see the hyperlink for those updated purchase limits. And for people who are new, HUD does have maximum purchase price limits, and they're derived from the IRS's mortgage revenue bonds. So we take the most current version when we do, but also our system does extract that information when you're entering in that sales price. Is there maximum loan amounts for any of the programs? So the answer is no. We also don't care about the loan to value. It really is income driven. So we look to your underwriting. It can be jumbo. It can be non-qualifying mortgage, non-QM. Grant funds are in form of a second mortgage and included in CLTV. So we don't look at the LTV, but if you're looking at it for first off, for HMDA purposes, for AUS, it's not a loan. So technically it's a mortgage, but it's a grant that's forgivable. So we typically see people on your end classifying it as a community second. So we would just look for you to make sure you're meeting your CLTV requirements, where we don't look at those. These are all really good questions, so thank you. All right, let's see what else we got. What day will the banks fill out their applications for ABP, how, and Lou to submit grants? So the member bank and credit union application period was the month of February. So that time is surpassed. So people who are taking the training should be the banks and credit unions that applied to offer the programs. They'll be getting their award notifications sometime next week. We're still doing intake of our executed agreements, or basically the contract saying you're going to abide by all of our policies and procedures that are pertinent to each respective program. Is there an asset test piece? So no, there is not, as we mentioned. If a borrower was to refinance due to lower interest rate within the 5-year time frame, can we get the EBP subordinated so they don't have to pay it back? Yes, the answer is yes. We don't want to take back the money. Unless that new lender requires and they tell you that they cannot subordinate. That's a whole different discussion, but we actually want you to subordinate and not require the home buyer to pay back the grant, because we really want to promote equity and wealth for that home ownership. So if they're doing a rate and term to get a better rate, if they're doing a cash out for some reason, maybe they need debt consolidation, or they want to extract the equity to go to college, start a small business. That's really what the mission of these programs are. Or if they want to take a home equity to do some improvements on their home, we will accept subordination for all those. It's not a rigorous underwriting process. It really just requires you executing the template and submitting, and we'll talk about that at disbursement. But definitely important to know that this information is listed in just easier language that's palatable to a potential first-time homebuyer on that disclosure. The first 4 pages are really informative, so they understand these things, that there is a lien on the property for 5 years. You can subordinate if you refinance. If you sell the property, here's what happens. We're all in for income. So those first 4 pages, I recommend really getting to know them, so that way you can explain the information that the homebuyer has in front of them before they sign it. If someone has a pre-approval for an affordable housing development lottery, is waiting for the lottery in May, can we reserve the funds? Their key factor for qualifying. They have to have a purchase and sales agreement on that. That's the challenge with the lottery. But if you're saying that there's a lottery in May, the good part is you could get the information in the system to see what program they're eligible for. But we have multiple drops throughout the year, so we're going to be releasing money April, May, June, July. So there's still that opportunity. What income documentation do you require for W-2 income? It's pay stubs or a contract or a Fannie Mae verification of employment. Definitely read those 3 sections of the income guidelines, which I hyperlinked in the chat, because if there are some unique scenarios, we try to give you those best practices. Okay. Where are those videos? So in this PDF on slide 21, if you click the technical assistance via YouTube, it'll bring you to our suite of trainings. Also, here's our department. If you ever have questions and you need immediate assistance, Livia Bork, she is our Vice President, HCI Operations Manager. We have a rock star of analysts. We have Sam Jurgens. We have Jack Newton. We have Isabel Tapagna. And then we also have Kevin Ryan, who is an analyst and oversees our analysts that work with the programs alongside myself. And if you're not familiar with me, I'm Caitlin, and I do manage all of the programs. So, really use us for that extra technical assistance after you're looking through all of these resources. Or if you ever can't find a resource, reach out to us. We get it. There's a lot of information on our website, so we try to make it as straightforward as we can. But is there a schedule for the program rollouts? April 1st is next, but how often? So yes, if you go to the website, it will give you a list of the dates under, say if you're going under the EBP page, and I believe it's under procedure requirements, you'll have the schedule. And it's also located in the slide deck. I believe it's in the beginning part. It might be slide 6 off the top of my head, I'm unsure. If a borrower gets the grant, how long can she refinance and sell? Need to report to lender and grant program. Any limitation on what type of property? So it's a 5-year retention period and lien on the property. So if they have to subordinate due to refinance, or they want to sell and there might be repayment, you just have to reach out to us within 30 days for us to determine what's the next step about that. And no, there's no limitation on what they're buying in the future. If you're talking about what type of property that they're buying at time of grant reservation, it's all types of properties, and you can find that in the slide that is eligible uses. Do you have the lift up marketing flyer available? I only see EBP in-house. So in order to get the lift up marketing material, you have to click the lift up landing page when you're logged into the community lending. EBP and how is one document. The LUH is separate just because it is people-based and tied to the special purpose credit program. Are you able to post the procedures in the material sections? So I did put it in the chat, the hyperlink. Unfortunately, the way the GoToWebinar platform is, it will only allow 5 attachments. But if you look through the chat, I posted as many hyperlinks that you can bookmark. All right. I believe we have a couple more questions. Can the application submitted have a non-occupying co-borrower? So yes, they wouldn't be considered a household member. you would want to look at our income guidelines that go over what we require for that. You need a letter that says they won't occupy the property from the non-occupant as well as the home buyer. And I mentioned previously, we don't include them in the households, but if the reason why they are a non-occupant co-borrower or co-signer is due to the debt to income ratio and they're going to be financially contributing, we don't count them in the household, but we would count the income that that home buyer was receiving. So strongly recommend looking at that. There is an official list of accepted compensating factors. It's in our EBP How procedure. So it is, what is the current rent? Do they have 2 to 6 months reserves, and what is their back end ratio, or if no back end debt? 37 is the housing ratio, correct? Not DTI. So yes, thank you for clarifying. Yes, so we're only looking at housing ratio because we don't look at credit report. We don't look at other liabilities. You're really giving us that picture. So that's why we ask you to enter in those compensating factors, similar to other housing finance agency subsidy programs. For the permanent rate buy down program, can you use the down payment assistance as well? Yes, you just can't use our grant money to buy points because the PRB program is a 2% discounted rate. Can you clarify loan versus grant? So it is a grant that's forgivable after 5 years. There's no loan, there's no P&I on it. And the money that we get at the Federal Home Loan Bank, it's not federal funds. We are cooperatively owned by our shareholders, which are our banks and credit unions, and we allocate a certain amount of funding based on our earnings toward these programs. So they are grants. Right, a lot of questions. Let me see if I have a couple more. Okay, answered that. Do you foresee money drop date changes? No, we do always say that it's subject to change just based on the demand. Last year, for example, there were a lot of people that wanted EBP How funding, so we did move some of the money over, and that really just depends. We do an analysis of what the housing market is. We try to be thoughtful to spring market. Also, the money that we allocate to each of the 3 programs varies every year. It's not a set amount every year. It fluctuates just because when interest rates are high, it's great for the Federal Home Loan Bank because that's how we get our liquidity is from institutions like yourselves borrowing from us. When interest rates are low, that hurts our business model because that's where we're getting our income to generate these programs for affordable housing. So I hope that answers that question. What happens if there's solar? We don't have any restrictions if there's a lien on the property because of it. We're not lien sensitive. We'll sit in any lien position. And that's one of the things too, when I was talking about the example of a LUH buyer that received our funding and some Mass Dreams grant money. We'll sit in even 4th position. You would just want to make sure that you're being thoughtful to your first mortgage about that solar, just because we don't have restrictions. Even though you are classifying the money as grant, the mortgage still has to be recorded, correct? Yes, it does. It does have to be. And we will talk about that in the disbursement training in April. And will LUH funds become available on the same schedule as funds for EBP How? Yes. So this is the first year we're launching all 3 programs together. And that way you have the time to market the programs as a suite if you are applying for all 3, but then also you have the proper time to be able to determine within your existing pipeline or future pipeline what eligible borrowers meet either EBP, How, or Lift Up. Awesome. Well, that is all the questions, and we are right down to 4 minutes to spare. I'll give that back to you. Thank you so much for your time. I hope this was valuable. These questions were great, and reach out to any of us, and we look forward to working with you. And the recording will be available for those who are unable to get in. I do apologize. Have a wonderful day.